In this video, I'm going to show you how to invest your first $1,000 wisely, step by step, without gambling, stress, or confusion. You'll learn how to make that money grow safely, how to protect it from inflation, and how to use it to start building real wealth in 2026. Now, maybe $1,000 doesn't sound like much, but here's the truth. Most self-made investors started with less. They didn't begin with millions, they began with discipline. What separates those who stay stuck from those who grow is not the amount, it's the mindset. Across the world, people use that first $1,000 differently. In Japan, small investors apply the Ikemoka principle. Never invest all at once. Spread decisions like clouds that move slowly, but always forward. In Israel, entrepreneurs practice Maimonides' ladder of wealth, a philosophy that says your first investments should help you stand, not run. And in the US, the 2020s created a new generation of micro-investors who turned their extra cash into digital portfolios, index funds, and side businesses that grew silently over time. The goal isn't to turn $1,000 into $1 million overnight. It's to turn it into knowledge, control, and leverage. Because once you understand how to multiply a small amount, you can multiply any amount. By the end of this video, you'll know exactly where to start, which mistakes to avoid, and how to build a personal investment plan that works, even if you've never invested before. And if you stay until the end, I'll share a strategy used by several small investors in South Korea, a 12-month pattern that doubled their returns without increasing risk. This isn't about luck. It's about logic, patience, and building habits that outlast your fears. Before you invest your first $1,000, you must learn how investors actually think. Because investing is not about money, it's about psychology. The average person sees $1,000 and asks, "What can I buy?" An investor sees the same $1,000 and asks, "What can I build?" That's the difference between spending and investing. Spending brings comfort today. Investing creates options tomorrow. Let's start with the 3 rules of investor mindset. Rule 1, respect risk. Every investment carries uncertainty. The goal isn't to avoid risk, it's to manage it. Smart investors never risk what they can't replace. If losing $100 would break your peace of mind, you're not ready to risk it yet. Start smaller. Rule 2, focus on return and time. Everyone wants fast money, but great investors think in time, not luck. They measure how long their money works, not how fast it grows. The secret isn't the amount you earn, it's how often it repeats. Rule 3, never invest emotionally. When people invest out of greed or fear, they make blind decisions. Professionals invest based on data, patience, and purpose. In Japan, investors use the concept of machi-machi, meaning soft but firm. They stay flexible with trends, but firm in principles. In Israel, the idea of Vitae teaches confidence through preparation, not arrogance. The lesson? The more you understand, the less you panic. Before putting your $1,000 anywhere, ask yourself 3 questions. Can I afford to lose this money without regret? Do I understand how this investment makes money? Do I trust the system I'm entering? If you can't answer all 3, you're not investing, you're guessing. Once you shift from emotion to logic, your money stops being a number and becomes a worker. When you're starting with your first $1,000, your goal isn't to chase massive profit. It's to learn how to make your money move safely. That's why the best investors begin with tools that protect and grow capital slowly. 1. Index funds, the quiet millionaire maker. An index fund is like a basket that holds pieces of hundreds of companies. Instead of guessing which stock will win, you own small parts of many, and your money grows with the economy itself. Warren Buffett once said, "If you don't want to spend your life studying stocks, just buy the S&P 500. In the last 30 years, that single index has returned an average of 10% per year. Proof that patience beats prediction. You can start investing in index funds through apps like Vanguard, Fidelity, or even platforms in Latin America that allow partial shares. Start small, automate contributions, and forget about daily noise. 2. ETFs, diversification without complexity. ETFs, exchange-traded funds, work like index funds, but they trade like stocks. That means you can buy or sell them anytime. A beginner-friendly choice is something broad like VTI or VO. Both track the US market and have low fees. 3. High-yield savings accounts and money market funds. While these won't make you rich, they're perfect for parking your money safely while it earns interest. Many banks in 2026 offer returns of 4 to 5% annually, better than letting your cash sleep in a traditional account. 4. Micro-investing apps. If you live paycheck to paycheck, use apps that invest your spare change, like Acorns, Stash, or Revolut. These tools turn daily spending into slow but steady investing. The goal right now isn't to become rich. It's to become consistent. Because when your money learns discipline before risk, it never forgets it. Now that you understand the options, let's build your plan. How you divide your $1,000 depends on your risk tolerance, your comfort with volatility, and patience. Let's go through 3 sample portfolios you can copy or adjust. 1. The conservative portfolio, low risk. 50%, $500, in a high-yield savings account or money market fund. 30%, $300, in a broad index fund or ETF like VO or VTI. 20%, $200, for emergencies, an untouchable cash buffer. This is the best option if you're new, cautious, or saving for something near-term. It grows slowly but safely. 2. The balanced portfolio, moderate risk. 40%, $400, in index funds or ETFs. 30%, $300, in high-yield or bond funds for stability. 20%, $200, in micro-investments or fractional shares of tech, energy, or healthcare companies. 10%, $100, left as cash for quick opportunities. Balanced investors focus on steady growth. They're not chasing excitement. They're building endurance. 3. The growth portfolio, higher risk, higher return. 60%, $600, in diversified ETFs, stocks, global, or emerging markets. 20%, $200, in thematic or innovation funds, AI, clean energy, biotech. 10%, $100, in crypto or experimental projects you understand. 10%, $100, in a secure savings account as backup. This approach fits people under 35 who can handle market ups and downs. The key rule? Never invest in what you don't understand. Your goal isn't to impress anyone. It's to grow steadily. Once your money is divided, set up automation. Every month, add $50 to $100 to each category. That rhythm transforms $1,000 into $5,000 faster than emotion ever could. Remember, wealth is built by systems, not surprises. Once your money starts growing, the real game begins, reinvesting. Most beginners make a simple mistake. They take profits too early. But the wealthy don't chase profit, they chase compounding. Let's break this down. Compound growth is when your money earns interest on both your initial amount and your previous gains. It's exponential, slow at first, then unstoppable. Albert Einstein once called it the eighth wonder of the world. Here's an example. If you invest $1,000 with a 10% annual return and reinvest every year, in 10 years you'll have $2,593. But if you withdraw your gains yearly, you'll have only $2,000. The difference, almost $600, came from patience, not effort. That's why investors in Japan and Israel focus on what they call long cycles. In Japan, the Nenkin Keisen principle means annual calculation. Investors check their portfolios once a year, not every week. It protects them from panic and short-term noise. In Israel, a similar habit exists called Seder Kesef, order of money. Profits are reinvested in rotation. 70% goes back to the investment, 20% to new opportunities, and 10% as self-reward to keep motivation alive. Psychologically, this system creates momentum. Your brain begins to link waiting with reward, not anxiety. Here's a simple reinvestment model you can apply. Every 3 months, review your gains. Reinvest 80% automatically into the same or similar assets. Keep 10% liquid for diversification. Use the remaining 10% to celebrate small wins. This keeps you consistent. You'll notice something magical after a year. Your balance grows even when you stop adding new money. That's not luck. That's the compounding machine quietly working for you. The secret isn't speed, it's endurance. Wealth compounds faster than effort. Once you let time do the heavy lifting. When people invest for the first time, they often lose not because of bad markets, but because of bad habits. The difference between a broke beginner and a confident investor is not knowledge. It's emotional control. Let's go through the most common traps. 1. The get-rich-fast trap. Many new investors believe $1,000 can become $10,000 overnight. They see viral videos or fake gurus promising 300% returns. The truth? Real investors play the long game. The slowest investment often becomes the safest one. In South Korea, mentors tell young traders, if it looks too fast, it's probably fake. 2. The all-in trap. Putting all your money into one shiny thing, a trending stock, crypto coin, or friend's business, is not bravery, it's gambling. Diversification isn't optional, it's armor. Even the best investors lose sometimes, but they survive because they never bet everything on one card. 3. The fear of missing out trap. When you see others getting rich, your emotions trick you into chasing trends. In 2021, millions bought crypto at its peak out of FOMO, and most lost half their money. Smart investors wait until hype dies down and fundamentals remain. Patience is a profit multiplier. 4. The no-plan trap. Most people invest without purpose. They throw money into random assets, hoping something sticks. But a portfolio without a plan is like a map without destinations. Always define your goal. Are you investing for freedom, retirement, or learning? The answer changes every decision. Finally, 5. The checking too often trap. Watching your investments daily is like planting a seed and digging it up every morning. Nothing grows under constant anxiety. In Japan, investors literally schedule, no check, months to protect their discipline. Your first $1,000 isn't a lottery ticket, it's your training ground. If you protect it from emotion, it will teach you everything you need to know about real wealth. Money has no borders, but wisdom does. Around the world, people have found unique ways to turn small beginnings into powerful systems. Learning from them gives you shortcuts experience alone can't teach. In Japan, small investors often follow a principle called sumitate NISA, meaning steady accumulation. It's a government-supported system that encourages citizens to invest small monthly amounts into approved funds. Many Japanese workers invest the equivalent of $50 to $100 per month automatically. They don't time the market, they trust consistency. After 5 years, those tiny deposits often double simply through discipline and compounding. In Israel, entrepreneurs and families apply what's known as the 10-10-80 method. They give 10%, invest 10%, and live on 80%. This approach combines ethics with strategy, building generosity, stability, and long-term growth. A study by the Top Center showed that Israeli households using this pattern had 40% higher savings rates than those who didn't. In South Korea, young adults have created investment clubs, small groups of friends pooling $500 to $1,000 each to invest together. They meet monthly, review performance, and vote on decisions. It's community-based investing, less risk, more accountability. In the United States, beginners use Roth IRAs or fractional shares to get started. With as little as $10, they buy tiny portions of major companies like Apple or Microsoft. That's how millions began investing during the 2020s, by owning small but real pieces of the global economy. In Mexico and Latin America, people use cooperative investment circles, modernized tandas. Instead of cash exchanges, digital tandas allow members to contribute and invest collectively in safe mutual funds. It's ancient trust, updated for the digital age. The lesson is simple. There's no single right way to invest. But everywhere, success shares 3 ingredients: consistency, patience, and community. You're not just growing money. You're joining a global rhythm of people learning to make wealth quiet, ethical, and lasting. Where you invest your $1,000 matters almost as much as how you invest it. The right platform protects your money, simplifies your experience, and builds trust. The wrong one can cost you everything, even before you start. So let's break it down by type and region. For global investors, platforms like Vanguard, Fidelity, and Charles Schwab remain the gold standard. They offer low fees, access to index funds, and decades of credibility. These are perfect for people in the US, Canada, and Europe who want stability and transparency. For beginners in Latin America, newer options like GBM Plus, Mexico, Walla, Argentina, and Belo, Brazil, allow you to invest small amounts directly in ETFs or fractional shares. They make investing feel local, simple, and modern. No paperwork, no middleman. If you prefer mobile apps, tools like eToro, Interactive Brokers, or Trading 212 are designed for global users. You can start with as little as $10, follow verified portfolios, and copy professional strategies. But here's the rule: never copy blindly. Use other investor strategies to learn, not to depend. For safe, interest-based growth, look into high-yield savings and money market funds offered by fintechs like Wise, Revolut, and SoFi. Many of these pay up to 4 to 5% annually with instant liquidity, perfect for beginners. Warning signs to avoid: apps that promise guaranteed profits, hidden fees, or confusing withdrawal rules. Platforms without clear regulation or user support. In Japan and Korea, regulators require platforms to educate users before allowing investment, a model the world should copy. If your app teaches you before taking your money, that's a green flag. Choose a platform that aligns with your rhythm. You don't need the fastest one. You need the most honest one. Remember, technology is a bridge, not a shortcut. It should connect you to your goals, not distract you from them. Once your money is working, the hardest part begins: doing nothing. Most new investors fail not because they choose the wrong asset, but because they check it too often. Here's the paradox: the more you stare at your portfolio, the less it grows. Professional investors follow a rhythm. They don't wake up and check their stocks like social media. They schedule it. They understand that markets move daily, but wealth grows monthly, quarterly, and yearly. The 1-minute rule: never spend more time watching your portfolio than you spend improving your skills. If you check your investments for 1 minute a day, spend at least 1 minute learning something new about money. Balance observation with education. In Japan, investors follow the Ninkin rule, meaning once per year. They only evaluate their performance annually, focusing on long-term improvement instead of daily emotions. In Germany, retirement funds are reviewed twice a year by law, not because they can't check more often, but because too much control kills patience. You can apply the same discipline. Check your portfolio once a month. Once per quarter, rebalance your investments, adjust percentages slightly. Once per year, celebrate growth, no matter how small. If you find yourself anxious when markets drop, remind yourself of this: markets fall fast, but they rise forever. Every crash in history, 2008, 2020, 2022, was temporary. The investors who stayed calm were the ones who profited most when things recovered. Think of investing like planting bamboo. For years, you see nothing. Then one day, it grows meters overnight. That's how compounding works. The real art of investing is not predicting, it's enduring. Your patience is the best investment you'll ever make. If you've reached this point, you already understand something most people never will. You don't need a fortune to start building wealth. You just need clarity, patience, and courage. Your first $1,000 is not a test of luck. It's a test of identity. It's proof that you can delay comfort, trust time, and make money serve you instead of the other way around. Let's recap what you've learned today. You learned to think like an investor, not a spender. You discovered safe, realistic ways to grow small capital. You learned how to divide, reinvest, and protect your money from emotion. And most importantly, you learned that the key to wealth isn't speed, it's structure. Across Japan, Israel, and Korea, investors start small and think decades ahead. They don't ask how fast, they ask how long can I keep going? That's why their results compound while others quit. The next time you see a friend chasing overnight profits, remember this: you're not competing with them, you're competing with your old self. Every dollar you invest with purpose brings you closer to peace, independence, and time, the three currencies of real wealth. And if you feel like $1,000 isn't enough, remember, a tree doesn't start as a forest. It starts as one seed, planted once, watered always. So start now. Start small. Stay consistent. Your future self will thank you for every dollar you respected today. And in the next video, we're going global. I'll show you the top countries to invest or start a business as a foreigner in 2026, where opportunities are exploding, where your money grows faster, and where people are turning vacations into income streams. Because sometimes the best investment isn't just money. It's where you choose to plant it. Stay focused, stay patient, and I'll see you in the next one.